We have to prepare consolidated financial statement every year. Say for example, if it is now already 31st of December 2003, which is 2 years after the day of acquisition, so of course we have to prepare the consolidated financial statements on 31st of December 2003. So first of all, the first step is we'll repeat what we have done in the past. So of course we will repeat this journal entry that we have done at the day of acquisition. This is exactly the same as what we have done at the day of acquisition. So from this journal entry, we have established the NCI at the day of acquisition and also the goodwill at the day of acquisition and also the fair value adjustments at the day of acquisition. Of course, we understand that now it is already 2 years after the day of acquisition, so many of these figures will not be updated. So we have to update these information, and therefore we collect further information relating to all this for these 2 years. So here we got some information. Say for example, we have been told that the undervalued inventory of 130,000, this 130,000 has been sold. If this piece of inventory has been sold, that means in our warehouse at the closing stock, we don't have this inventory anymore. So therefore, this debit to the inventory is no longer required. So we have to eliminate this closing inventory. So therefore, we credit away the inventory. So as a consolidation adjustments, we credit inventory. So that's why the adjustments to this fair value adjustment will be 0. Whenever we credit inventory, we have to debit cost of goods sold, because cost of goods sold is opening inventory plus purchase minus closing inventory. If closing inventory is smaller, cost of goods sold is higher. So therefore, we need to debit cost of goods sold and credit inventory. But this is the inventory in 2002. Now it is 2003 already. So this is the cost of goods sold in 2002. Cost of goods sold in 2002 must have been closer to retained earning. Therefore, we debit retained earning. If you simply debit retained earning 130,000, that means you reduce the retained earning for the parent only. But actually, this subsidiary is a 90% subsidiary, so only 90% should be borne by the parent. So we debit retained earning 90%, the 10% goes to NCI. When we create this inventory, you have attracted a deferred tax liability. So now when you eliminate this inventory, we have to eliminate the relevant deferred tax liability. Therefore, when we credit the inventory, we debit away the deferred tax liability that we have created for this adjustment. 20% tax rate, 20% tax rate for retained earnings, 20% tax rate for the NCI. So this is to adjust for the deferred tax implication. After inventory, we have got the land. We have got the land here. So the land, undervalued land of 390,000 was sold in 2003. So this debit to the land, 390,000 is no longer required because this piece of land has been sold, no longer in your closing balance. So therefore, we credit land 390,000. So we credit land 390,000. If this is an inventory, we debit cost of goods sold, but this is not an inventory. This is not part of our main business. So we don't debit cost of goods sold, we debit gain on disposal. So the gain on disposal that the subsidiary has recorded has been overstated. Right? So now we debit away the gain on disposal, partly that we have overstated. So we credit land and debit gain on disposal. We debit gain on disposal because this is a current year 2003 gain on disposal. If this is a gain on disposal last year, we should debit retained earning and NCI, just like what we have done for inventory. When we create the land, you have got a deferred tax liability. Therefore, now you credit away the land. So we have to eliminate the relevant deferred tax liability, 20% tax rate, 20% tax rate. Because you debit gain, which is a current year figure, so we credit tax expense, right? 20% tax rate. After inventory, after land, the third item will be the building. Building is here, right? 1.3 million. So we did not sell this building. So this building will be used over 50 years. Higher value, higher depreciation. Therefore, we have to adjust for the depreciation. The figure increase. The increase in the fair value is 1.3 million, which should be depreciated over 50 years. So 1.3 million divided by 50 years, this will be 26,000 every year. Every year, additional depreciation will be 26,000. Therefore, we debit depreciation 26,000. This is for 2003. This is the second year after the day of acquisition. There should be an additional depreciation last year. Additional depreciation last year must have been closer to retained earnings. So we debit retained earnings. 90% parent retained earnings, 10% NCI. So this represents 2 years additional depreciation. When we create the increase in the value 1.3 million, we have credited deferred tax liability. So now the deferred tax liability should be gradually reversed. 20% tax rate, we debit away part of the deferred tax liability. Because you debit depreciation, we credit tax expense 20%. We debit retained earnings, so we credit retained earnings 20%. We debit NCI, so we credit NCI 20% deferred tax implication. Inventory, land, building, equipment. The fourth item is the equipment. Equipment is an overvalued item. So once you have credited the equipment, again, we did not sell it. We use it over 5 years. Lower fair value means there should be lower depreciation. Lower depreciation means we have to credit depreciation. The fair value reduction is 390,000 to be depreciated over 5 years. So 390,000 divided by 5 years will be 78,000 every year. So we credit depreciation. Depreciation should be reduced 78,000. This is for 2003, current year. This is for last year. Last year's depreciation must have been closer to retained earnings. So we credit retained earnings 90%. We credit NCI 10%. So this represents 2 years reduction in depreciation. When we create this credits to the equipment, you created a deferred tax asset. Therefore, this deferred tax asset should be gradually reversed. So remember, because you debit accumulated depreciations, you credit deferred tax asset. Because at the very beginning, what you have created is a deferred tax asset for the equipment. So here we have to reverse the deferred tax asset. 20% tax rate, 20% tax rate. Why? Because you credit depreciation, you debit tax expense, 20% tax rate. Now we come to the fifth item, which is for the contingent liability. Contingent liability. This is the fifth fair value adjustments that we have made. So this contingent liability has been paid off in 2002, last year. So no longer we require this credit to the contingent liability because it has been settled. Therefore, we have to debit away this contingent liability. So we debit contingent liability. In the subsidiary's own book, they must have not recorded this liability, and therefore when they pay for this item, they recognize it as an expense. So in the subsidiary's own book, probably they have debit and expense and credit bank. No matter what they have debit, now we are settling a liability. Therefore, we should credit away this expense that the subsidiary has recorded. But this is our expense in 2002, last year, so we don't credit expense, we credit retained earnings. So 90% retained earnings, 10% NCI. And again, when we credit the contingent liability at the day of acquisitions, we have created a deferred tax asset. So now we have to eliminate the deferred tax asset. So therefore 20% tax rate, 20% tax rate, 20% tax rate. So we have adjusted for the 5 fair value adjustments. The question tells us that the goodwill that we have established here at the day of acquisition has suffered from the impairment loss. Goodwill is an asset, so that's why we have to perform impairment review. We have been told that there should be an impairment loss of 520,000 in 2002. Therefore, no longer it should be 5.95 million. So we have to make impairment for this goodwill. So we credit goodwill 520,000. If this is a current year impairment, we will debit impairment loss. But this is the impairment loss in 2002. Therefore, we debit retained earnings, 90% retained earnings, 10% NCI. Why? Remember, retained earnings is the retained earnings for the parent only. So that's why we have to separate into 90% retained earnings and 10% NCI. NCI has to share its portion. Now we have adjusted all the fair value adjustments as well as the goodwill. We updated the figures. One more figure that we have to update is the figure for the NCI. In the first journal entry, NCI was 1.4 million at the day of acquisition. Now it is already 2 years after. We have to update the figures. Last year, the profit was 728,000. Current year, the profit of the subsidiary 400,000, and the subsidiary has paid out a dividend 455,000 in the current year. So this should be adjusted accordingly. So we share the last year's profits to NCI. So we credit NCI. NCI can share 10% of the increase in profit. This is the profit last year, so therefore we debit retained earnings. That means the retained earnings to the parent go down because we share the profit to NCI, and the NCI figure go up. 10% of last year's profits. Now we come to the current year profit. Current year profit. The question states that the current year profit is 400,000. So if there's no adjustments, we should simply share 10% to NCI. But if we can still remember, we have made several adjustments which affect the current year profit. Say for example, in here, in this journal entry number 3, you have once debited the gain on disposal with a related tax credit to the tax expense. Journal number 3. Journal number 4, you debit depreciation, so the profits will go down with a related credit to the tax expense. Journal number 5, we have credited depreciation, so profits will go up with a related debit to tax expense. Journal number 6 and 7 has no impact on current year profit. Therefore, only 3 journal entry, number 3, number 4, and number 5. Number 3, profits will go down with a related credit to tax expense. Number 4, profits will go down with a related credit to the tax expense. Number 5, profits will go up with a related tax expense. So 1, 2, 3 adjustments for the subsidiaries' profit. The subsidiaries did not take into account these adjustments. This is a consolidation adjustment. Therefore, we have to adjust it from the reported figures of the subsidiary. So altogether, the adjusted profits for the current year, 129,600, 10% goes to NCI. Therefore, we debit profit to NCI and we credit NCI. So we share the retained earnings, we share the current year profit, but the question told us that this subsidiaries has paid out a dividend, 455,000. Whenever the subsidiaries pay out the dividend, it comes from the profit. We have already shared the profits, so dividend income from the subsidiary should not be regarded as a second source of profit. Therefore, we credit away all the dividend paid by the subsidiary. 90% the parent must have recorded as dividend income. Recording dividend income means they have credited dividend income. To eliminate, we debit dividend income. 90% we debit dividend income, 10% we debit NCI. After all these adjustments, so we start NCI with 1.4 million. There are many adjustments affecting the NCI, right? Say for example here, we debit NCI, so NCI should go down. So NCI should go down by 45,500. These are all the adjustments. If you put everything into the worksheet, your NCI figures now should be 1,392,420 in your consolidated worksheets. We should be able to provide an analytical check for this NCI. So NCI can be analyzed into the book value of the net asset, fair value adjustment, and the goodwill component. Book value first. 2 years ago, it was 7.67 billion. So we got last year's profit, current year profit, and we have paid out dividends. So this is the updated figures for the book value of the net asset. If the question provides with us the latest financial statements, we can find the latest financial statements book value of the net asset, assets minus liability. But here the question did not tell, so we calculate the figure from the book value of the net assets 2 years ago, plus last year's profit, plus current year's profit, minus the dividend that we have paid in the current year. 10% goes to NCI. Second component is the fair value adjustments. Two years before, at the day of acquisition, there was 5 items which has got fair value adjustments. Some items has been sold, so therefore no longer we have to take into account. Say for example, the land has been sold, inventory has been sold, contingent liability has been settled, so only 2 items left. One is building and equipment. For the buildings, at the day of acquisition, it was 1.3 million. 2 years has been depreciated, so the total useful life is 50 years, so therefore 48 years remains. We are always talking about the remaining portion of the fair value adjustments. Next year, this will be 47 out of 50, 46 out of 50, etc. until we finish or until we dispose it. So 1.3 million, 48 out of 50 years useful life after tax, NCI share 10%. Similarly, for equipment, it was 390,000 at the day of acquisitions, so 3 years out of 5 years left, remaining portion. Next year, it will be 2 out of 5, 1 out of 5, and then finish. After tax, 10% goes to NCI. Building is a fair value increment, equipment is a fair value reduction, so debit credit. The net debit is 81,120. Last component is the goodwill. At the day of acquisitions, the goodwill for the NCI was 529,000. This is the goodwill for the NCI at the day of acquisition. Now, goodwill has been impaired. The total impairment is 520,000, and we have shared 10% to NCI, so the goodwill impairment for NCI should be 52,000 because it is the 10% of the total impairment loss. So 529,000 is the goodwill for NCI at the day of acquisitions. 52,000 is the impairment loss. The remaining portion, 477,000. When we add together, NCI's share of the book value of the net asset, NCI's share of the fair value adjustments remaining, and also the remaining portion of the goodwill for NCI, you exactly get this 1,392,420.